Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. I continue to be very pleased to be able to bring you incredible guests so that we can try to figure out where we're at in the economy and where we're going next. We know that there's been a ton of volatility in the market. We actually saw some huge bounces in the equity markets Monday and Tuesday this week, only to be pulled back on Wednesday. So a lot of questions about where we're at, how long and how deep will a recession be? And what does that mean for the US Federal Reserve, the Bank of Canada, rates, job prospects, and how you can really position yourself to benefit going forward? So let me bring you our guest today. Larry McDonald is joining us. He is a New York Times best-selling author, founder of the Bear Traps Report, and a Wall Street veteran who was actually at Lehman Brothers during the financial crisis and was very well known for his thoughts post the crisis in terms of what he saw and all the imbalances that were being created at the time. Larry, welcome, and thank you so much for joining us.
Thanks, Catherine. It's great to be back in Toronto.
I want to first start off with what we've learned today, and everybody knows I pre-taped this on a Thursday. We had big news that the UK Prime Minister has resigned. What does that mean to all of us sitting here at home in North America?
Well, it was a real miscalculation on the part of the Conservatives, but the biggest impact really comes back to central banking, because at the end of the day, this is kind of like a preview of what's going to happen in the United States over the next 12 months, where you have, very large deficits on both sides and a government that misjudged the breadth of the deficits, and a central bank like in the Bank of England that was embarking on a very aggressive quantitative tightening plan, which is basically reducing the balance sheet of the central bank. And what that means is essentially the fiscal side of the government of the United Kingdom and the monetary side weren't on the same page, and it created this really embarrassing move in yields. I mean, you're talking about 10-year long-term bonds in the United Kingdom going from very 3% to 5% in a week or two, and bonds in general were annihilated. And so what it means for people at home right now is that the Fed, which is basically conducting a very aggressive monetary policy, is very similar in the same boat, where they're trying to tighten policy very fast, and there's going to be a political pushback in the next 6 months, which is negative for the dollar, and it's going to have a huge impact on asset prices.
And just to be clear, so that we all understand what happened in the UK, and I guess what you think will happen in the United States, is that you've got the central bank tightening, but at the same time, you had a prime minister in the UK wanting to ease by tax cuts and really stimulate the economy. So you've got tightening and loosening at the same time. Do you actually think that that's what we'll see in the United States, that you'll see fiscal stimulus out of the Biden administration?
Well, that's a good point. That's a great way to explain it. Now, keep in mind, the Biden team just passed an infrastructure bill, last year, and we've done a ton of fiscal largesse. But we've done in the United States, we did, two consecutive $3 trillion deficits, so $6 trillion of deficit spending in a couple of years. And so what I mean is that when you push up the Fed funds rate, and that's what central banks do when they try to tighten, you're increasing, like, for example, the cost of living adjustment at the Social Security. We estimate the next 12 months is going to be an extra 110 billion, 110. And then your extra interest on the debt, because there's so much debt in the United States, close to 31 trillion of total debt. When you push up that front end of the yield curve, you're pushing up yields, and you're trying to do quantitative tightening, so you're pushing up yields that way. And there's an extra 200 billion of interest over the next 12 months. So that's 300. And then there's interest on reserves. And so after Lehman fell, one of the things I talked about in my book, A Colossal Failure of Common Sense, is when Lehman failed, they forced the banks to keep all these extra reserves, and massive amount of reserves, and the central bank pays the banks for those reserves, and that's another 200 billion of interest. So you're talking about a $500 billion swing over the next 12 months of additional interest that is people like Elizabeth Warren and Bernie Sanders are going to be like, that money should be going toward social programs, and instead it's going to the banks, it's going to extra interest
Okay.
costs. And that's going to be a massive political pushback.
Okay, we'll take a quick break. We'll be right back. Larry, I just want to pick up on something that you mentioned in terms of, we've already had a lot of infrastructure spending in the United States. Why is it then that the United States hasn't gotten caught up in this circular trap that the UK got caught up in so quickly? And therefore, will it actually happen?
Okay, so it has a lot to do with the existing budget and how many bonds they were going to sell this year. So when the new government put forth the new plan, there was because of, as you explained it, because of the tax cuts, at the same time the central bank was doing quantitative tightening, there was an additional 60 billion, potentially 80 billion of extra bonds that would have to be sold. And because of that disconnect, where they're going to sell more bonds than was expected, that created an initial panic. And then on top of that, you had the move up in yields forced. There were a lot of these derivative structures underneath the surface with these pension funds. And you had a massive amount of unwinding because the rates went up so fast that there were losses of hundreds and hundreds of billions of dollars on UK government bonds, and the pension funds got into a short, basically a squeeze, not a short squeeze, where they had to sell their long positions, and so that forced an even further rise in yields. So it's complex, but it was a pretty scary moment.
Yeah, no, and I appreciate you describing it, because it is important to understand, because in some ways the financial crisis was so long ago. You and I, of course, were height of careers during that time, but you forget all of the unwinds, whether it's pension funds or institutions and derivative plays underneath the surface, and that's I almost forgot it, and I'm glad you explained it to me. But let me ask you then, when we take a look at the big picture right now, are you concerned about some of the imbalances in the economy or on the balance sheets? What's top of mind for you when you look at the United States and, of course, Canada as well?
Well, we run a Bloomberg chat with about 650 institutional investors in 23 countries. And so it's a conversation during the day. We produce research as well. But the conversation that I'm hearing from the institutional clients is the disconnect around the move in the U.S. mortgage market, the move in U.S. commercial mortgage-backed securities. So RMBS, commercial mortgage-backed securities, and residential mortgage-backed securities, CMBS. Those losses are just really mounting very, in a dark manner. And then the securitization business, and that was another thing that I talked about in my book, where that's freezing in Europe, it's kind of freezing in the United States. So that means that the banks are getting kind of stuck with more and more of these bad loans every single week, every single month. And all of that is really going to come to a head in the next 6 months. So the U.S. is definitely going into recession, but certain parts of the economy are already far deeper in recession than others.
And what would those be? Because I'm trying to understand, why are these bad loans? I mean, it's difficult, if you're, not in depth in the market like you are with chats of institutions around the world. Like, what's going on underneath the surface in terms of the CMBSs and the RMBSs?
Well, the incredible divergence. So McDonald's is 6% off the highs, Pepsi 6% off the highs. Some of these regional banks are very close to the all-time highs. But then you have JP Morgan last week was 40% off the highs. And then you have Bernardo Realty, which is a major exposure to U.S. commercial real estate, 75-80% off. And then you have Ally Financial, which is a big mortgage/auto lender. Their stock was 30-40% off in a couple of weeks. So underneath the surface, there's a lot of these structured products, a lot of leverage that's now literally the divergence that I'm seeing in the market is something I haven't seen since Lehman. It's just spectacular, where you literally can have some banks in the United States, say a regular regional bank might be near the highs, but then you have other financial institutions that are at 2-year lows and down 40%. And so it's kind of like there's some parts of the economy that are still holding up, but underneath the surface, there's a lot of damage because the Fed has done, 325 basis points of rate hikes in 6 months. The system just can't take it.
And so that leads us to the big question. And, when we see the markets rally, it's because a lot of investors are saying that, the system is breaking and that the U.S. Federal Reserve is going to recognize that. And then they're going to, stop tightening and they're going to lower rates. Do you believe that? I've got 20 seconds in this segment and we'll pick it up on the other side of the break. But what do you think here?
Yeah, the Fed, a number of academics are coming out. The Fed doesn't know what they've already done. And that's the dangerous thing. So I think now they're opening their eyes to maybe they've overcooked the goose.
Okay, take a quick break, right back. So Larry, in the last segment, you said that the Fed likely realizes that they've overcooked the goose. What does that mean? And importantly as well, you talk about everything that's been going on now, that we will see the greatest migration of assets in 2023. What does that mean?
Sure. Well, since the last hiking cycle, Catherine, since 2018, the planet Earth has added 50 trillion with a T more debt. And a lot of that debt was issued at less than 1% coupon, less than 2% coupon. So the losses on that debt is so spectacular underneath the surface that it's creating a lot of damage to the system. And
wait, Larry,
that
let me
means
just
that
stop
when
you
you
there.
do,
I just want people to understand that when rates rise, the value of bonds go down.
Yeah.
That's the loss that you're talking about. Okay, sorry, go on.
Exactly. No, that's important. And exactly, interest rates up, bond prices down. So you're talking about such a damage with, this is an experiment. These are academics that have never taken professional risk. They've never sat on a trading floor the way you have or the way I have. And they really just guessed, right? They're like, okay, they just did 325 basis points in 6 months. That's the same amount of hiking or more than they did over 3 years in the last cycle. And it's extremely dangerous with this much more leverage in the system. And so it's very clear that they know. I was in Washington last week. I've met with some people at Treasury, some ex officials, and they said they're getting blood-curdling phone calls from finance ministers around the world. So there's no question that the Fed is waking up to this. And when they slow down and when they reverse policy, the dollar is going to start to weaken. And the amount of money that's in financial assets versus hard assets is just spectacular. Everybody's invested for the previous decade, right? So the previous decade, you have very certain deflation, very certain, and you had a lot of money in growth stocks. You didn't have any money in emerging markets or value stocks or commodities. Now, this year, you've seen some money move into commodities, but we're going to see the greatest migration of assets from financial assets, which are growth stocks and bonds, to hard assets. And that means value stocks, steel, copper, aluminum, gold, and silver, especially for solar. And so this big migration of assets into value stocks, emerging markets, and hard asset companies. That's where the big migration is going to go. For example, one quick point, in 1981, the last time we had sustained inflation, industrials, materials, and energy were 49% of the S&P, 49%. As of like January, that number was down to like 12 or 13. So we're going to have a migration where the S&P is going to change from very heavy tech over the next 3-4 years to much more industrials, materials, and energy.
What has to be the underlying economic scenario for that to make sense? I mean, presumably it would be demand, but if we've got higher inflation or stickier inflation for longer, the whole issue in terms of the volatility in the commodity complex over the past number of weeks or however long, even though it's still elevated versus where it was, has been demand destruction concerns around the world.
Yeah, there's a lot of that. That's because of the dollar, right? So the dollar's like this global wrecking ball. There's 75 trillion of GDP outside the United States and only like 26 or 28 trillion inside the United States. So when the dollar rips higher, it crushes the global economy. That hurts demand. And that's what the Fed's been doing. They're trying to, really slow down inflation. But when they reverse policy, the dollar weakens. That'll support the global backdrop. And then at the end of the day, inflation this cycle is going to normalize at 4 or 5% instead of 1, 2, and then stay there for a number of years. And that's what creates this great migration. I'm very, very with the highest confidence that is about to happen.
Interestingly, as well, when you say that the Treasury is getting finance ministers from around the world calling them daily, I mean, I've heard this for quite some time now as well, because of the very strong U.S. dollar that's putting so much pressure on their currencies and importing inflation. Correct? Like that's something I don't think we hear a lot about that in the general news, do we? But this is happening behind the scenes.
Yeah, it's really a shame because much of the media establishment, even the Fed, they pretend to be so progressive. They pretend to be care about the little guy, which they do in the United States. But they're obliterating poorer countries. You've got to buy oil and gas in dollars.
Yeah.
So not only is oil up 10, 15%, you got to buy food in dollars, and all of this
Right.
creates essentially the Fed is exporting inflation to poorer countries around the world.
Larry, I just want to pick it up in terms of the strength of the US dollar having such a negative impact on so many emerging markets and their economies. It's interesting sitting here in Canada. I know you have a lot of Canadian clients as well. Our Canadian dollar has been dramatically reduced. Do you think we'll see a reversal? And if so, when? When do you think that the Fed is going to, pivot?
Well, the Fed will pivot between now and year end. And what I mean by pivot, it's not like 2018 pivot where they went from hiking to immediately to cuts. But this time they're going to go from very aggressive tightening to far less tightening. They probably cut or shave down the quantitative tightening plan in half because that's really creating the most stress. So that quantitative tightening plan will probably be cut in half between now and year end. But the Canadian economy is facing kind of two situations. One is you've got the move up in rates, and that's putting tremendous stress on the housing sector and the banks. But as the dollar weakens, it's going to support resources. And Canada is a very high resource economy, so Canada is going to benefit from this kind of reversal in policy. And it's a resource-based economy. There's a lot of incredible commodities and minerals up here that are extremely valuable for the next decade, and which we can get into. But yeah, it's bullish for Canada, but you also have a housing crisis that's going to unfold. So it's kind of has two things going on at the same time, one really bad and one really positive.
And so, where does that leave you in terms of some of your top ideas today?
Well, we love, for the last year and a half, we do trade alerts for clients globally, and we've recommended Cameco, CCJ. The company is, one of the largest producers of uranium, but now they're getting into the construction and the development of nuclear power plants in the world. So they're becoming more vertically integrated, which can be extremely profitable in the right cycle. So we love Cameco. We love Southwestern Energy and the natural gas space. SWN or FCG is an ETF that owns a lot of these natural gas companies, because we really have a very lasting and sustainable run in natural gas prices in the United States as we support the European economy. And emerging markets, Brazil, any country that has an economic activity that's heavily resource-based. And so Brazil has been underperforming the U.S. for much of the last 10 years, and now they're dramatically outperforming. So we love the EWZ, the Brazil ETF as well. But most of all, right here, when the Fed slows down, gold and silver, Hecla Mining. The Hecla Mining is the largest silver producer in the United States, HL Equity. And as the U.S. goes solar, as the U.S. goes electric vehicles, there's a whole new element of demand for silver. And as the Fed kind of slows down and reverses policy, gold and silver have the most upside. So those are our best ideas for 2000 in the first half of 23.
Great. And what about TLT going long, the long bond here?
Well, yeah, I think you probably can here in the next 3-4 weeks. If you look at ZROZ and TLT, the percentage that they're below their 200-day moving average is the greatest on record. So the ETFs are so far below their moving average, and you have a midterm election in Washington that probably goes to the Republicans. And our research shows, we went back like 50, 60 years, every time you go from one party control of the House and Senate to two-party control, there's an increased probability of serious gridlock that's typically bullish for bonds. So yeah, TLT, we'd be buyers here.
Okay. And just lastly, Larry, when you talk about owning hard assets for the next number of years, that this is kind of the shift, the migration that we're going to be seeing. A lot of people think that their hard asset, their number one hard asset, and their largest is their home, that real estate's a hard asset. I've only got about 20 seconds, but what do you say to that? Depends where.
Yeah, home building in the United States very cheap. I can't speak so much to Canada. I really have to do more work there. But yeah, home builders right now are a buy.
Okay. And do you think that homes in general are somewhat safe as an asset?
Yes, but in
Yeah.
certain parts of the world, because of this adjustment process with rates, like in the United Kingdom, for example, 40 to 50% of the housing market is exposed to these mortgage resets. I haven't done my work there on
Okay.
Canada, but if Canada is very exposed to mortgage resets, that's extremely dangerous for the next year.
Okay. Larry, we got to leave it there. Incredible speaking with you and to be able to share your insights to our viewers. Thank you.
Thanks, Catherine. Great to see you.
Thank you. You as well. And thanks everybody for watching.